Hi, I'm Steve Bigger, Director of Equity Research for S&P Capital IQ. Welcome to this week's edition of Equity Analyst Forum. With me today on Equity Analyst Forum is airline analyst Jim Corridor. Jim, welcome to the program.
Thanks for having me, Steve.
So this week's focus stock of the week is Delta. Can you tell us a bit about the company?
Delta is one of the largest airlines in the world, and we think that they're leading what is, in our opinion, a fundamentally changed U.S. airline industry that has really transformed itself through mergers, capacity discipline, and a change in which the way they all compete with each other, which is to try and actually make money for a change instead of just competing with each other to the death. So we think Delta, which has already integrated its merger with Northwest Airlines and is well ahead of the pack in terms of generating a unit revenue premium, is actually well positioned to continue to make money and to return some of that cash to shareholders over the next several years.
So what are the earnings drivers for the company right now then?
Yeah, they're actually experiencing pretty strong demand, both on a leisure and a corporate basis, and they're taking that and they have strong cost discipline, so they're actually growing operating margins, and they're benefiting from lower fuel prices as well. So we think that the earnings drivers for the company are strong for the next several years.
Okay, how about valuation? So you have a strong buy in the stock. What's your target price and what valuation technique are you using?
Sure, we have a $42 target price on the stock, and we use enterprise value to EBITDAR, which is EBITDA plus aircraft rent. And what this does, it allows you to equalize out those airlines that use mortgages for planes versus those that rent planes. So on that basis, our target price is an 8.4 enterprise value to EBITDAR, which is well above peers and at the high end of the company's range. But we think that the company deserves that based on how well they're doing versus peers, their global name recognition, and the fact that we expect them to grow both cash and earnings over the next several years better than the industry.
How about risks? What would you highlight there?
Certainly, if fuel prices start to spike back up, that would be a risk. Or if price competition rears its head again, and if capacity grows too fast, that would make it more difficult for the company to raise fares, which we think they will.
Great. Thanks, Jim.
Thank you.
And that's been this week's edition of Equity Analyst Forum. We'll see you again next week.